Picture this. You're at your desk, surrounded by the hum of computers and the soft glow of monitors, about to execute a routine transaction, selling $58 million in assets. For most people, that's an unimaginable sum. But in the world of global finance, it's just another day at the office. The stakes are high, but the process is familiar, almost automatic. But then, with a single slip of your finger, you accidentally type in an order for $444 billion instead of $58 million in a split second. A tiny error transforms an ordinary day into a potential catastrophe. This isn't a scene from a financial thriller or a Hollywood blockbuster. It actually happened, right inside Citigroup's London office. The mistake sent shockwaves through the European markets, causing panic and confusion among traders and investors alike. One person, one keyboard, and a momentary lapse in concentration, yet the consequences were anything but small. That single keystroke triggered a financial earthquake, shaking the very foundations of the market. The error was so massive, it bordered on the absurd. Imagine walking into a cafe, ordering a coffee, and accidentally offering up the gold reserves of an entire nation as payment. That's how outlandish this mistake was. And yet this wasn't the result of fraud, sabotage, or some elaborate scheme. It was just a simple, all-too-human slip-up. Proof that even in a world dominated by technology, people are still at the heart of every transaction. In high-speed finance, where billions can be gained or lost in the blink of an eye, a small mistake can unleash chaos. Within minutes, billions of dollars in value were wiped out and the market was thrown into turmoil. To put it in perspective, $444 billion is more than the entire GDP of many countries. An order of that size should have triggered every safeguard, every alarm bell, every emergency protocol in the system. Yet, for a few critical moments, none of those systems responded. The alarms stayed silent, and the safeguards failed to catch the error before it hit the market. Suddenly, the market was flooded with sell orders, and no one was prepared for the tidal wave of transactions. Traders scrambled to make sense of the chaos, but the damage was already done. This isn't just a story about a clumsy error. It's a wake-up call about the systems designed to prevent disaster, and how, in this case, they failed spectacularly when they were needed most. The Citigroup flash crash quickly became a textbook example of a fat finger error, a term that sounds almost comical but describes a phenomenon that can have terrifying real-world consequences. It's a cautionary tale for the entire financial industry. Even the most powerful banks with the most advanced technology can be brought to their knees by a single, unchecked human mistake. The fallout from that day would haunt Citigroup for years, serving as a stark reminder that in finance, the smallest errors can have the biggest consequences. So, what's a flash crash? It's a term that's become infamous in the world of finance, but what does it really mean, and why does it matter to anyone watching the markets? Think of it as a sudden, violent plunge in stock prices, sometimes 10, 20, even 90%, happening in seconds. It's not a slow decline or a gradual sell-off, but a breathtaking freefall that seems to come out of nowhere, leaving traders and investors stunned. Then, just as quickly, prices snap back. It's chaos, then calm. The market seems to lose its mind for a moment, only to regain composure almost instantly, as if nothing ever happened. In the old days, traders on the floor might have caught a bizarre order. Human intuition and experience could sometimes spot mistakes before they spiraled out of control. Today, computers run the show. The trading floor is now a digital battlefield, where algorithms and machines make split-second decisions. Algorithms execute trades at lightning speed with no common sense, just code. They don't pause to question if something looks odd. They simply follow instructions, no matter how irrational the outcome. If a 444 billion sell order appears, the computer doesn't question it. It just acts. There's no gut feeling, no hesitation, just pure automation, for better or worse. One error can cascade instantly, like tightly packed dominoes falling. A single misstep can set off a chain reaction, spreading panic through the entire system in the blink of an eye. The Citigroup mistake was the first domino. It was a simple error. But in a world ruled by algorithms, even a small mistake can have massive consequences. Their algorithms started selling huge volumes across Europe. In seconds, markets from London to Frankfurt felt the shockwaves, as automated systems responded to the sudden flood of sell orders. Other algorithms saw the sell-off and joined in, amplifying the panic. It's a digital stampede, with each program reacting to the moves of the others, creating a feedback loop of fear. Prices plummeted, not because of bad news, but because of a technical glitch. There was no economic disaster, no breaking headline, just a flaw in the system, magnified by automation. Once the error was found and fixed, the panic faded and prices rebounded. The market returned to normal, but the scars of those frantic minutes remained. But in those few minutes, fortunes were lost, and the system's stability was tested. Investors were left questioning how something so dramatic could happen so fast. Flash crashes are a product of our high-speed automated markets. They're a reminder that technology, while powerful, can also be unpredictable and fragile. They're not about real value, they're about how fast mistakes can spiral. In a world where milliseconds matter, a single error can move billions. The lesson in today's markets: a single error can trigger a global storm. The interconnectedness of our financial systems means that no market is truly isolated, and it can all be over before most humans even notice. In the blink of an eye, billions can be lost or gained, and the world moves on, often without ever knowing just how close it came to disaster. It was May 2nd, 2022, a quiet bank holiday in London. The city's financial heart was unusually still, with most offices closed and only a handful of traders at their desks. But beneath the calm surface, the world's markets were still ticking, ready for anything. On Citigroup's Delta One desk, a trader was preparing to execute what should have been a routine transaction, selling 58 million in stocks for a client. It was a standard task, the kind performed countless times a day. But in a split second, a simple mix-up occurred. The trader accidentally entered the amount into the wrong field, transforming a modest order into a staggering $444 billion trade. An error so large it defied belief. The system's pop-up warnings flashed urgently, signaling that something was off. Yet, perhaps out of habit or pressure, the trader overrode them, trusting the process would catch any real mistake. Some of the order was blocked by internal controls, but astonishingly, $189 billion still slipped through the cracks, making its way into the market's bloodstream. That massive order was handed off to an algorithm programmed to sell gradually and avoid market disruption. But instead, it unleashed a torrent of trades, overwhelming the system. In just a few minutes, $1.4 billion in stocks hit the market at once, sending shockwaves through trading floors and digital exchanges alike. Automated systems everywhere sprang into action, reacting to the sudden flood. The flash crash began, with prices plummeting and alarms blaring across the financial world. The digital dominoes fell, one after another, all set in motion by a single fat-fingered keystroke, a tiny error with massive consequences. The safeguards that should have stopped the disaster failed at every step, unable to contain the chaos once it began. What should have been a simple, uneventful trade spiraled into a market-wide disaster, leaving traders scrambling and markets reeling. The error itself was almost laughably simple, a single misplaced keystroke, but the consequences were enormous, rippling outwards in seconds. In the high-speed world of digital trading, one mistake can topple the whole system, reminding us just how fragile our interconnected markets truly are. Fat finger error sounds silly, but it's deadly serious in finance. It's a simple typo, like putting $58 million in the wrong box, turning it into $444 billion. These aren't crimes, just accidents, but in high-speed trading, accidents can be catastrophic. The Citigroup trader confused notional total value with quantity, number of units. The system let the trader override warnings, treating alerts as nuisances, not safeguards. Working from home without colleagues to double-check made things worse. The real problem: systems prioritize speed over safety. A series of small cracks, design flaws, weak controls, and human error lined up perfectly. The result? A single slip triggered a market meltdown. When Citigroup's algorithm started selling, chaos erupted. It dumped hundreds of stocks across Europe, Paris, Amsterdam, Stockholm, at any price it could get. High-frequency trading algorithms saw the panic and joined in, pulling buy orders and selling to avoid losses. Prices plunged. Sweden's OMX index dropped 8% in 5 minutes. Billions in value vanished in seconds. For investors, it looked like a financial apocalypse. But the crash was all machine-driven. One error, multiplied by thousands of algorithms. Within 15 minutes, the error was found, and the order canceled. Prices rebounded almost as fast as they fell. The market survived, but the scars remained. The incident proved how fragile the system is. One mistake and the whole market can tumble. Automation amplifies errors at lightning speed. The lesson: in a digital market, chaos is only a click away. How did this happen at a bank like Citigroup? Their risk controls, the digital guards, were fundamentally flawed. The order entry system's warnings were confusing and easy to override. There were no hard blocks or mandatory supervisor checks for massive trades. Real-time monitoring was too slow. By the time anyone noticed, the damage was done. The culture prioritized speed over safety, leaving the system wide open to human error. One trader, working from home, could bypass every safeguard. The guards weren't just sleeping, they never woke up. When the dust settled, Citigroup had lost 48 million in minutes. The flash crash wiped out billions in market value, and some investors suffered real losses. The reputational damage was even greater. Trust in Citigroup's controls was shattered. Events like this shake confidence in the entire financial system. Regulators spent months investigating, costing time and money for everyone. The real danger machines amplified a human error into a systemic crisis. The price of a single click was more than money. It was a warning about the risks of unchecked speed. In finance, one mistake can ripple through the world. Regulators took 2 years to investigate, then hit Citigroup with a $61.6 million fine, one of the largest ever. The penalty wasn't for the trader's mistake, but for the bank's failure to prevent it. Reports exposed weak alerts, slow monitoring, and poor risk controls. For Citigroup, the fine was manageable, but the public embarrassment was costly. The incident forced banks everywhere to upgrade their systems: hard blocks, smarter alerts, real-time checks. The goal: stop human errors before they become market disasters. The fine was a wake-up call for the industry. In the end, the real cost was the overhaul of trust and technology. The Citigroup flash crash is a lesson in the balance between human and machine. Trust alone isn't enough. Every step needs robust, intelligent verification. Strong safeguards aren't optional, they're essential. Even the best systems are vulnerable to simple mistakes if checks can be bypassed. The solution: hard blocks, smarter alerts, and a culture that values safety as much as speed. This lesson goes beyond finance. Anywhere algorithms and humans interact, verification is key. Technology is powerful, but it lacks common sense. Humans are fallible. Only by having humans and machines check each other can we build safe systems. The flash crash forced a global giant to confront its weaknesses and push the industry to do better. In a world moving at light speed, our safety checks must be even faster.